Warning: these social media platforms may be hazardous to your health. Censorship kills. Pain coming. This has been a PSA by Breaking Spectre. Well, good morning, everybody. How we doing? Spectre here. It is now the 28th day of October. We are just about through the month of October here, looking ahead to November. Deep into the fall season here, a little chilly out here this morning. Got a little rain in the old forecast, and hopefully you guys are doing well wherever you may be situated around the country, or perhaps overseas, wherever you may be dialing in here today. A lot of ground to cover here this morning. We're going to talk a little bit about, the rundown of the oil market here this morning. We got a few things by way of energy-related stuff, oil and coal. Going to talk about the taper tantrum and that has occurred. Germany talking about GDP cuts, things of that nature. Skimpflation, shrinkflation, rising rebellion of workers, etc., and a couple other odds and ends. So that being said, stick around. I'll see you back here in just a minute. Hey everybody, Spectre here. Want to tell you about my Teespring store that I just opened up with a handful of products in that for you guys, the listeners, the audience, those that are in chat on a day in, day out basis. Always appreciate your support, and I figured what the heck, we'll throw some merch out there for you guys. And so obviously with YouTube and Nerd Shenanigans as of late, I'm going to be looking to expand to other platforms, and well, that all comes at a cost, so I figured what the heck. That being said, I got some t-shirts and that out here. You can see those in black, white, and gray. Spectre Does News. I got a water tumbler, 20 ounce there. Got a coffee mug you can get in black or white. And of course, we got the Let's Go Brandon #FJB shirt, which you can also find in black, white, or gray. Right now, you can find that all over at https specters-storefront.creator-spring.com. That's https://specters-storefront.creator-spring.com. Thank you for your support. All right, welcome back. Before we get into everything here, a quick flash through the old weather here. Looks like we got an interesting system marching across the middle part of the country here. Interesting how far up this little system reaches all the way up to northern parts of Canada clear up here. Way up here, almost to Greenland area, trouncing on down. And of course, we see that running down through Minnesota, Iowa, Missouri, Arkansas, marching across. We got this little leg down here through the Ohio River Valley and all the way down to the southeast here. So I'll be keeping an eye on that. That's probably part of the rain and that we'll be seeing here through the better part of the day. No word yet on whether or not this old bomb cyclone and that was off the East Coast that Murphy and that declared an emergency disaster declaration and that for in New Jersey in recent days, if that actually manifested and had any damages as well. I have to keep an eye on that as well. All right, well, that being said, futures rebound despite distress signal from collapsing yield curve. U.S. equity futures rebounded from yesterday's late-day sell-off when a collapsing yield curve sent recessionary policy error shockwaves across the market, as investors pointed to solid earnings to indicate that a slowdown is nowhere near. NASDAQ 100 futures led gains among other key U.S. gauges after setting an intraday record on Wednesday. Dow Jones and S&P 500 futures gained too. The 10-year Treasury rate was flat, while the 2-year yield added 5 basis points. Oil was lower and the dollar was steady, while Bitcoin rebounded after the liquidity-draining Shiba Inu melt-up finally cracked over midnight. And here we get a take of the old E-mini S&P futures. Says in U.S. pre-market trading, Caterpillar rose 2% after beating earnings, with the industrial bellwether announcing it was successfully passing on price increases. Ford jumped 8.5% in pre-market as the carmaker's third-quarter earnings report brought positive surprises on cash and dividends, according to analysts. eBay fell 5.7% amid mixed views on the e-commerce company's revenue forecast. eBay also expanded its stock buyback program. In the latest Chinese crackdown, Up FinTech fell 21% and Futu plunged 27% after a PBOC official called cross-border online brokers illegal. Interesting. Investors will now focus on the two giga FAAMGs, Apple and Amazon.com, which will report earnings later on Thursday. And of course, I'll have more to say about that here momentarily. Flashing into some of the movers of the day, CNP Assurances shares jump as much as 36% after majority owner La Banque Postale said it plans to buy the rest of the company. Zur Rose shares jump as much as 9.7%, the most since May 7th, after the online pharmacy firm announced a diabetes collaboration with Roche. Shares in Roche are up 0.4%. AB InBev shares jump as much as 6% after the world's biggest brewer reported third quarter results that showed beats everywhere, according to Citi, which basically penned it as neutral. WPP shares jump as much as 4.9% after results, the most since January 6th, with Citi highlighting the advertising firm's massive third quarter beat, and Shore Capital upgrading the stock to buy from hold. ST Micro shares jump as much as 5.6% in Milan trading. Citi says the semiconductor maker's results are reassuring, with third quarter revenue in line with expectations, notwithstanding a shutdown at its Malaysian factory. Arcadis shares sink as much as 18%, the most since October 2018, after the engineering services firm's third quarter earnings missed estimates, KBC says in a note. Also, rates treasury curve continued its flattening streak during Asia session and European morning, with long end yields richer by 2 basis points on the day. There we see some of the 2 by 10s net dropping. And then, of course, I'm going to talk a little bit about this here in just a moment. Overnight, Australian 2-year bond yields exploded by a near record amount, surging by a 5 sigma 30 basis points after the RBA refused to buy bonds maturing in 2024, effectively and unexpectedly ending the central bank's 0.1% yield curve control. So aside from that, the market snapshot here shows S&P 500 futures up 0.1% to 45.51 even. Stocks Europe 600 little changed at 473.78. The Nikkei down 1% to 28,820 and change. Shanghai Composite down 1.2% to 3518.42. Australia S&P ASX 200 down 0.2% to 74.30 and change. Brent futures down 0.4% to 84.24 a barrel. Gold spot up 0.3% to 1801.76 per ounce. And the US dollar index little changed at 93.86. Some other overnight news out of Bloomberg: the European Central Bank is set to reassure consumers facing surging prices and investors considering the consequences that it's just transitory and not about to spiral out of control. Out of Decision Guide. The benchmark rate for euro funding fell to an all-time low, driven by a near-record high level of spare cash in the economy. Austrian Finance Minister Gernot Blumel urged the European Central Bank to raise interest rates to curb inflation, which he said has been causing him sleepless nights, according to remarks published on Thursday. European natural gas and power dropped after more signals from President Vladimir Putin that Russia will send extra gas to the continent next month. Commodities from coal to aluminum posted huge swings Thursday afternoon in Asia, as traders said prices were reacting to speculation that China's leadership is growing concerned over recent sharp declines in prices. UK Chancellor of the Exchequer Rishi Sunak appears to have embraced surging inflation, as he delivered a budget that laid out plans to add £75 billion, or about $103 billion, of stimulus across the next 6 years. The UK's debt chief says a larger-than-expected cut to bond sales this fiscal year reflects a commitment to funding rules, even if that means surprising dealers and investors. The UK government hit back at France over its proposed retaliatory measures in a dispute over fishing access, as post-Brexit tensions between the two countries increased further. Beijing City will join a trial program aimed at eliminating all so-called hidden government debt, underscoring China's deepening campaign to improve public finances and cut risks. Out of News Squawk, and back still in Asia, commodities whipsawed on speculation of China's next energy step. Unibail sinks as Morgan Stanley flags soft footfall data. Another Chinese developer is sinking as junk bonds sell off. And Keza is the latest property developer worry in China. So not just limited to Everbank, but several others as well. Top European news. Unicredit says Pashi talks long and detailed before collapse. Sunak's budget giveaways for bets for Bank of England rate hikes next week. La Banque Postale to buy out CNP in largest 2021 insurance deal. And Bayersdorf falls. RBC says outlook disappoints after third quarter miss. Flashing forward into the event calendar for today, well, not too much on there, but 8:30 this morning we got third quarter GDP annualized quarter over quarter estimate of 2.6. Prior was a 6.7. Third quarter PCE quarter over quarter estimate 4.5%. Prior was 6.1. Third quarter GDP price index estimate of 5.3. Prior was a 6.1%. Third quarter personal consumption estimate 0.9 versus a prior 12%. That's quite a drop. Also 8:30 a.m. October initial jobless claims estimate of 288,000. Prior was 290. Continuing claims estimate of 2.42 million. Prior was a 2.48 million. 10 a.m. we got September pending home sales year over year estimate down 3%. Prior down 6.3%. Pending home sales month over month estimate of 0.5% versus a prior 8.1%. And at 11 a.m., October Kansas City Fed manufacturing activity estimate of a 20. A prior was a 22 rather. So that's a quick run through of what lies ahead. Also on the day here, today being Thursday, we had some pre-bell reports in that. It was Shopify. We talked about Caterpillar briefly. Merck on the docket here this morning. Altria, AB, InBev, Comcast, to name a few. After the bell, we got Amazon lined up. We've got Gilead, Western Digital, and Decker's Brands Net, to name a few on this Thursday. And then tomorrow, obviously, we'll be looking at some of the big heavyweights in energy stocks like Exxon, Chevron, ConocoPhillips, etc., etc. So, speaking of energy, a global oil shortage is inevitable. This out of oil price. Svetlana Pereskava says while oil and gas companies come under pressure to reduce production, the world's thirst for new supply is only growing. Without a significant uptick in investment, demand for oil and gas will surpass supply in the not-so-distant future. The disconnect between the political desire for less fossil fuels and the global hunger for fossil fuels could drive the price of oil up to $100 a barrel. Now, mind you, the self-fulfilling prophecy of Goldman Sachs just barely a month or so ago said we'd be in the range and near $90, and lo and behold, here we are. Chronic underinvestment in new oil supply since the 2015 crisis and the pressure on oil and gas companies to curb emissions and even keep it in the ground will likely lead to peak global oil production earlier than previously expected, analysts say. This would be a welcome development for green energy advocates, net zero agendas, and the planet if it weren't for one simple fact. Oil demand is rebounding from the pandemic-driven slump and will set a new average annual record as soon as next year. The energy transition and the various government plans for net zero emissions have prompted analysts to forecast that peak oil demand would occur earlier than expected just a few years ago. However, as current investment trends in oil and gas stand, global oil supply could peak sooner than global oil demand, opening a supply gap that would lead to increased volatility on the oil market, with spikes in prices and, potentially, structurally higher oil prices by the middle of this decade and beyond. So, talking about supply could peak before demand, well, on current trends, global oil supply is likely to peak even earlier than demand, Morgan Stanley's research department wrote in a note this week, carried by Reuters. The planet puts boundaries on the amount of carbon that can safely be emitted. Therefore, oil consumption needs to peak, analysts at Morgan Stanley said. The problem with the world is that oil consumption, wishful thinking, investor pressure, and all, is not peaking, nor will it peak until the end of this decade at the earliest, according to most estimates. OPEC expects global oil demand to continue to grow into the mid 2030s to 108 million barrels per day, after which it is set to plateau until 2045, as per the cartel's latest annual outlook. Some other analysts expect peak demand at some point in the late 2020s. Investment in new supply, however, is severely lagging global oil demand growth. Demand is growing again after the 2020 COVID crisis, and, contrary to some expectations from early 2020 that the world's oil consumption would never return to pre pandemic levels, demand is currently just a few months away from hitting and exceeding those levels. And I think I'll break from that there just to highlight the fact that, one, here we are talking about the COP26, and that just around the corner in Europe. And we also find out, and as we'll get into here this morning, talking about coal and energy and everything else, what is happening in China and Russia at the moment. Interesting, isn't it? So we find out that not only are these knuckleheads in governments around the world cutting off their noses to spite their face, but all their projections are wrong, just like they were with COVID, by the way. And yeah, rather than oil diminishing and coal bad and everything else, this whole business of greenification of everything and ESGs, well, we're quickly finding out it's just not going to cut the mustard, is it? It's not there. And not only that, as the article alludes to here, that demand is only going to continue to grow through the 2030s. So we got a little problem here, don't we? COP folks say one thing, but yet demand is going the opposite direction. So that being said, U.S. coal stockpiles slump to two-decade low as power plant demand surges. Yep, that dirty coal, here we are, demand rising yet again. Something's going to have to give, isn't it? One of the biggest ironies this year is a transition from fossil fuel generation to green energy has created a global energy crisis that is forcing the U.S., among many other countries, to restart coal-fired power plants ahead of the Northern Hemisphere winter. Coal is roaring back this fall, but supplies are not catching up with demand. According to Bloomberg, U.S. coal supplies dropped to 84.3 million tons in August, the lowest level since 1997. And here we see that depicted graphically per Bloomberg's piece here. Coal inventories plunging at U.S. power plants. And it says, as of August, about a quarter of all U.S. power generation was derived from coal. As winter approaches, coal-fired power plants will become a more significant percentage of all U.S. power generation. Uptick, huh? Where are all those wind turbines and solar panels? Power plants are expected to burn 19% more coal this year because soaring natural gas prices have made it uneconomical to produce power. In return, this is forcing generators to burn through coal reserves much quicker, and gas has caught coal producers off guard who cannot bring new coal to the market. And of course, U.S. power plants burn more fossil fuels this year, again, rising. The ability for the producers to respond is not what the utilities thought it was, Paul Lang, CEO at Arch Resources Inc., said during a conference call Tuesday. It just doesn't exist anymore. Weeks ago, Ernie Thrasher, CEO of Xcoal Energy and Resources, the largest U.S. exporter of fuel, said demand for coal will remain robust well into 2022. He warned about domestic supply constraints and power companies already discussing possible grid blackouts this winter. He said they don't see where the fuel is coming from to meet demand, adding that 23% of utilities are switching away from gas to burn more coal. There are not enough coal miners to rapidly increase mining output. And if you've watched the broadcast at all over the last, many weeks, you'll recognize this graph, and that, the miners just aren't there to produce said coal. So where is this all going to come from? Joe Kraft, CEO for Oklahoma-based miner Alliance Resources Partners, LP, warned Monday coal stocks for customers are at critically low levels. Inventory declines came on very quickly as the global energy crisis emerged this year. Stockpile trends were well in line for the first half of the year, but stockpiles began to drop as soon as July rolled around. S&P Global Market Intelligence data shows Central Appalachia coal prices have surged 39% since the start of the year to $75.50 a ton due to supply constraints. Matt Preston, director of the North American Coal Markets Research for Wood Mackenzie Ltd., said total U.S. inventories could slump by 50 million tons by the end of the year. Stockpiles are coming down very rapidly, Preston said. If we have a cold winter, and there has been lots of talk that there could be a cold winter, we could see some issues. With natural gas, coal, and oil prices all soaring, is a clear signal the green energy transition will take decades, not years. Walking back fossil fuels for unreliable clean energy has been a disaster in Asia and Europe. It could soon cause trouble in the U.S. These power-hungry continents are scrambling to source fossil fuel supplies, as stockpiles are well below seasonal trends ahead of cooler weather. Suppose La Nina conditions produce cooler weather trends in certain parts of the world. In that case, especially Asia, Europe, and the U.S., coal demand could continue to increase, which would benefit Peabody Energy Corporation's share price. And of course, that's been ticking upwards. So far, Peabody's earnings have tripled as coal roars back under a Biden administration. And along those same lines, Chinese coal prices plunge after Beijing central planners impose price caps. And remember, it's only been a week or so ago. You find out that many of the provinces and whatnot in China all doing the same thing, right? And we find out that the CCP is basically says procure coal at all costs, even at a loss. Even if you have to operate your facility at a loss to keep the lights on and keep the factories humming, right? And that's exactly what they did. And so all of a sudden, this little rift that China had with Australia, well, suddenly all that goes away when you find out that you're going to have a whole pile of people in your population crying foul to the government about rolling blackouts on a regular basis, right? Says having soared to an all-time high as recently as 1 week ago, Chinese coal futures have lost nearly half of their value in the past 7 days in a sequence of limit down days as Beijing unleashed its latest crackdown on a commodity it felt was mispriced, despite urging energy firms to secure supplies at any price less than a month ago. And here we see the price caps net obviously having peaked and now coming downward. Says there is, of course, a perfectly simple, non-market driven reason for the plunge in prices. China ruthless authoritarians revealed a plan to impose limits on the price miners and thermal coal as they seek to ease a power crunch has prompted electricity rationing and even caused a blackout in a major city last month. According to Bloomberg, the National Development and Reform Commission, China's top central planning body, will set the price of the most popular 5500 NAR grade coal at 440 yuan, or about 69 bucks a ton, at the pit head. That price, which includes taxes, is a target rate, and there will be an absolute ceiling at 528 yuan, BBG's sources said. The plan, which is reportedly scheduled to last until May 1st of next year, is pending approval by the State Council, China's cabinet, and could be revised, according to the People. NDRC also wants downstream sale prices to be controlled, though it will let government set standards to limit the price of local coal trading, the People said. Coal importers will obtain subsidies to balance their losses, they said. The NDRC, the cabinet ministry that's in charge of energy prices, said in a statement late Wednesday that it held a meeting with the coal industry to study concrete measures to intervene in the coal market. How's that central planning working out for you, folks? The artificial 441 price target will apply to term supplies from coal mines to key users like power plants in order to ease generators' cash flow tightness and help boost electricity output, said Jia Zhang, a trader with Shanghai Dongwu Jiaying Investment Management Company. The guidelines for supplies to other users, which are decided by local governments, might be set at higher levels, she said. The bilateral pricing policies could ensure the coal supplies and prices for power plants and still provide incentives to coal mining production at the same time, Jha said. The price cap means that coal will be delivered to power plants at an acceptable level of 800 yuan a ton, she said. So I'll break from that there and just highlight the fact that welcome to central planning. That's exactly what would, possibly happen here stateside if things get wildly out of whack with all energy. We just got done talking about oil, natural gas prices going through the roof, coal prices through the roof, all the energy generators net switching what sort of supply they want to use to generate said power. But hey, all of AOC's and the Bernie Bros net out there that want to put our turbines out there and solar panels to work. We'll see how well that fares in the wintertime, huh? Didn't we get a lesson on that from Texas back early part of the year? Just saying. So, aside from energy, the taper tantrum has begun. Australia's 2-year bond just blew up after the central bank unexpectedly refused to buy it. Why is this going to be important? Well, I'll reserve my comments to the end here, but let's read through it. It says, no need to fear a taper tantrum, they said. It's all on the price, they said. Central banks have made it very clear what they are doing, and there will be no surprises, they said. Well, they, as usual, were full of shit. Because moments ago, this is what happened in Australia, where the central bank unexpectedly did not offer to buy the April 2024 yield target bond. The yield on the 2-year bond just exploded, doubling in the matter of minutes from 25 basis points to 50 basis points as the central bank's 0.1% yield curve control was summarily executed in broad daylight. And here, obviously, graphically, we can see that it shot up precipitously. So this was a VAR shock-inducing bond-crushing 5 sigma move and the biggest one-day surge in 2-year yields since the Lehman crisis, which we'd have to go back to 2008 to see how that fared, right? Heading into the Thursday session, markets were expecting the RBA to buy the April 2024 bond in order to contain the recent blowout in yields, which had moved far beyond the central bank's official 0.1% yield curve control barrier in the past day. However, the central bank shocked traders when it decided against buying any of the target bond, telegraphing that its yield curve control, at least on the short end, is now, for all intents and purposes, over. Not only will the move fuel expectations for Governor Lowe to entertain the idea of an earlier rate hike, but it will reprice the entire short end of the Australian yield curve, which will soon pancake in preparation for the coming inversion, which, in turn, will lead to shock waves that will be felt in Europe and the U.S. as soon as tomorrow, pouring even more fuel on the recent short-end fire that today sent the U.S. 2-year yields above 50 basis points and was at 0.52% at last check moments ago. And before readers ask what comes next, well, here's the answer. The first 2x10s inversion is already out in the open, courtesy of the Czech Republic, whose curve just telegraphed an imminent recession. It's the first of many. So, yeah, obviously Australia doing their part to curb things, obviously is going to have a knock-on effect worldwide. We see that via Czech Republic, rather. And, of course, we will likely see similar things play out here. Does that mean a recession is imminent? To be determined. But, rest assured, inflation is transitory. So, aside from that, Germany cuts 2021 GDP forecast by 25% due to, dun dun dun, soaring energy costs. Gee, who'd have thunk? All these energy producers and passing along the, sky high prices of natural gas, oil, coal, that's going to curb GDP? Wow. Little cause and effect action, I suppose, huh? Says 1 decade ago, in the aftermath of the Fukushima disaster, Germany's Angela Merkel announced that the country would permanently shut down 8 of its 17 reactors and pledged to close the rest by the end of 2022. 10 years later, crippled by the worst energy crisis in European history, and forced to comply with Russia's demands unless it prepared to freeze this winter as a result of stratospheric natural gas prices, the time has come to pay the piper. On Wednesday morning, the German government cut its growth forecast for this year by 25% from 3.5% to 2.6%, as crushing energy costs and supply chain bottlenecks for semiconductors have pressured the recovery in Europe's largest economy. Economy Minister Peter Altmaier said the economy remained robust despite the COVID-19 pandemic. But supply chain woes in manufacturing and a surge in energy prices were complicating the recovery. No, that wasn't what's complicating the recovery. It's bonehead moves by politicians and banksters pushing all this ESG BS. Let's get it straight, shall we? In view of the current supply bottlenecks and high energy prices worldwide, the hoped for final spurt will not happen this year, Altmaier said. In 2022, the economy will gain momentum significantly. The delayed recovery means that the German economy won't reach its pre crisis levels this year, but likely at the beginning of 2022. The revised government forecast for GDP growth compares with an April prediction for the economy to grow by 3.5% in 2021 and by 3.6% in 2022. So, to make the GDP cut more palatable, Germany hiked its 2022 growth forecast from 3.6% to 4.1%. But of course, few believe that since nobody, and certainly not economists, has any visibility into how 2022 will go. Altmaier said automobile manufacturers are currently not able to build hundreds of thousands of cars due to a lack of semiconductors and other electronic components. To ease the supply problems, the government is ready to support the construction of local semiconductor factories with several billion euros, Altmaier said, adding that he was hopeful this would mobilize even higher investments by companies soon. Well, that's a good idea. Onshore all your supply base, but where is the energy going to come from? Isn't that going to strain supplies even more? The widespread bottlenecks in production, coupled with unusually high demand, are leading to price increases, with the government expecting inflation to surge to 3% this year. Still, similar to establishment types in the US, the German government is sticking to its assessment that most of the price increases will be temporary. Berlin sees consumer price inflation easing 2.2% in 2022 and to 1.7% in 2023. Last year, national consumer price inflation stood at about 0.5%. Projecting hope, Altmaier said he saw a chance that the price rally on energy markets would end soon, adding that he did not expect any supply problems on gas markets during the winter months. Didn't expect any supply problems. Well, I suppose that's if you want to point the finger at old Putin for Gazprom and Nord Stream and not pumping enough gas through. But hey, never mind looking at the elephant in the room and, the energy policies and perhaps mistakes you guys made in shutting down nuclear power. Just a thought. But what do I know? So, that leads to this funny story. Europe leads in electric car sales. China is distant second and U.S. dismal. Interesting piece put together by Mike Shedlock here over at Mishtalk. And it's rather comical in the context of the articles Nat just described, because obviously, electric vehicles, what do you have to do to them? You got to plug them in. Where is all this power going to come from? Where power is beleaguered in Europe, China, even here in the U.S.? I guess we just don't drive in the wintertime. I guess that must be the concept here, huh? It says in each of the past 3 years, EVs only accounted for about 2% of the U.S. new car market. And here we see the breakdown: Europe in red, China in blue, U.S. in yellow, and everybody else in gray. Percent of market share looks like Europe is certainly leading the way, China second, and US down here. Says slow growth in the US, faster in China and Europe. Electric vehicles make up large share of new car sales in Northern Europe. So it looks like on a country by country breakdown, Norway, Iceland, Sweden, Netherlands, Finland, Denmark, Switzerland, Portugal, Germany, France, UK, Belgium. And there we have kind of the breakdown there. China clear down here. Spain, rest of the world, US, oh, we're way down in the list. But interesting. Out of Pew Research. Pew reports slow growth in the US, faster in China and Europe. Says outside of a few major metropolitan areas, electric vehicles aren't all that common in the US, while their numbers have grown rapidly in absolute terms in recent years. That's from a relatively small base. The US represents only about 17% of the world's total stock of 10.2 million EVs, according to IEA data. China is 44% of all the EVs in the world, more than 4.5 million, and the nearly 3.2 million in Europe account for about 31%. The fastest growth in EV sales has been in Europe, a compound annual growth rate of 60% from 2016 to 2020, compared with increases of 36% in China and 17% in the US. In each of the past 3 years, EVs accounted for about 2% of the US new car market. Now, California has by far the highest share of EVs of any US state, which is to be expected, given that for decades the state has required car makers to build EVs and has used an array of rebates and other incentives to encourage Californians to buy them. As of 2018, the most recent year for which federal data is available, California had about 12 EV registrations per 1,000 people. The next highest state, Hawaii, had roughly 6 registrations per 1,000 people. Says relative to the size of its vehicle fleet, though, Washington, D.C. may be the most convenient place in the U.S. to drive an EV. The 237 charging stations in the federal district have a total of 630 outlets, or one for every 487 privately owned cars and trucks on D.C. roads. Vermont, and yes, California place second and third. The national average is one outlet for every 2,570 private and commercially owned cars and trucks. So here we see the electric vehicle charging outlets mostly concentrated in large cities. No surprise there. U.S. car sales seasonally adjusted annualized. Here we see the lightweight vehicle sales, autos, light trucks, etc., dropping pretty substantially this year. Says the above chart shows seasonally adjusted annualized sales for each month. Hertz just announced it would buy 100,000 Teslas over the next 14 months, but that includes Europe as well. For details, please see Tesla joins the $1 trillion club and gets a big order from Hertz. Says it's reasonable to expect other car rental companies to join in, but we need to put things into perspective. U.S. annual vehicle sales have been averaging about 17 million a year since 2015, except for a March to August COVID impact in 2020 and the current supply chain disruption. Numbers are down since June due to a chip shortage. So, 100,000 out of 17 million is only 0.59% of sales, less than 1%. But yet EVs is all the craze, right? Didn't we just show that the infrastructure is only mostly around major cities? What about all these people where the infrastructure isn't? Guess what we're going to be driving? Gas-powered vehicles? Diesel? Yeah. And didn't we talk about demand on those at the front end of the broadcast here this morning? Probably still going to be peaking through the 2030s. Interesting, isn't it? So last but not least, by way of some financials this morning, skimpflation, shrinkflation, and the rising rebellion of workers and consumers. Charles Hugh Smith puts this together, says, while corporate America is focusing on preserving its precious profits, its customers and workforce are rebelling by walking away. Says, we all see shrinkflation on a daily basis. The 16-ounce container is now 13 ounces. The breakfast cereal box is now so narrow it topples over, and so on. More subtly, the quality of ingredients is also diminishing. Sharp-eyed consumers note that salt, sugar, and artificial flavors are increasingly used to mask the decline of quality as producers scrape the bottom of the barrel to eke out a profit. A recent NPR article proposes another form of untracked inflation, skimpflation, the decline of services as prices march higher. Meet skimpflation, a reason inflation is worse than the government says it is. The article notes that skimpflation isn't just a reflection of greedy corporations squeezing consumers to fatten profits. Cough, Disney, cough. Skimpflation is a direct result of the workforce declining to take jobs in which they are treated as chattel. The article mentions the wholesale decline of service that trace back to the shortage of labor. Long waits, spotty maid service. Hey, pal, you trying to lift those super jumbo mattresses to tuck in sheets all day long for garbage level pay? The demise of breakfast buffets and Disneyland's still defunct tram service, where entry prices have soared, but never mind, you have to come here, right? Because we brainwashed your kids, so pay up and shut up because you have to pay. There is no way out. As I have been saying for some time, labor has been devalued and denigrated for decades, most recently in my conversation with Max Kaiser. In an economy obsessed with measuring money, economists focus on pay and benefits, as if those metrics are all that matters. What about being valued, having some say about one's work, being respected for one's efforts, and earning dignity, not just rapidly depreciating dollars? None of those realities ever enter mainstream economics, but that doesn't mean they don't exist. It's not just low pay that makes work wretched, it's being treated as an object owned by the employer. Exploitation comes in many flavors, and they all taste bad. There's another factor left out of economists' obsession with counting dollars. The public is increasingly unhinged, and those having to deal with the public are paying an increasingly steep price. Flight attendants are being assaulted, workers are being threatened, cussed out, etc. Who wants a job where someone seeking to vent their rage can unload on an employee? Labor's quiet rebellion is feeding a self-reinforcing feedback loop of collapse. Corporate America, so accustomed to treating its workforce like donkeys, just load on more work, as responded to labor shortages by increasing the workload of those still on the job, burning out the remaining employees in the process. This Darwinian feedback, those willing to stay on the job are soon crushed by overwork and screaming customers. Increases the pressure on managers to cut services and load more work on whomever is left, as the sole means of meeting management's relentless demands for more sales and profits as the means to do so fall off a cliff. The financial nobility's answer? Give the super wealthy more trillions. Isn't trickling down to the real world, conjuring money out of thin air while changing absolutely nothing in the real world economy is not going to force workers to take chattel jobs, which only get more oppressive with each passing day. Imagine the berobed noble being driven down from the castle to address his army of indebted serfs, and you have a snapshot of corporate America. Oh, how sweet and endearing the noble's false phrases of appreciation, and then the whip comes out. It's not just the workforce that's rebelling. Consumers will eventually rebel too. The solution to corporate skimping on service is to simply stop giving them money. Don't wait in line for diminished products. Don't book the room or flight. Do something better and more satisfying with your time and money. The returns on trying to make all this go away by giving another trillion or three to the super rich are diminishing fast. Quiet rebellion leads to mass exodus, which leads to a death spiral of diminishing spending, debt, and the quantity and quality of goods and services, because the prime directive is increase profits or you're gone. And here's the nice graphic of the diminishing returns of monetary and fiscal stimulus, increasing sums yielding diminishing results while increasing risks of systemic collapse. Starting with QE 1, 2, 3, 4 Fed stimulus in March 2020, few trillion here, few trillion there, pretty soon financial and social orders crash, and effectiveness of stimulus in generating broad-based opportunity and reducing wealth inequality. You hit a breaking point, right? Says while corporate America is focusing on preserving its precious profits, precious stock market bubble, and even more precious billionaires, its customers and workforce are rebelling by walking away. Good luck wooing them back with declining quality in both jobs and products. While we glorify self-glorifying, supremely arrogant billionaires, the economy is quietly collapsing beneath the rah-rah cheerleading narrative. Reduce the purchasing power of wages for 45 years as you load on more work, and eventually the banquet of consequences is served. Hey, Mr. Billionaire, take this job and your rocket and shove it. Good piece by Charles Hugh Smith. I think he pretty well captures the sentiment. So, aside from some financials here this morning, we get this out of Gateway Pundit yesterday late. It says breaking Racine, Wisconsin County Sheriff's Office to announce proof of statewide election law violations Thursday at 11 a.m. So, here in a couple hours, we'll see what comes of that and what that may entail. The Racine Sheriff's Office will hold a hearing on Thursday at 11 a.m. at the Sheriff's Substation. Sheriff Christopher Schmeling will unveil the results of an extensive investigation with implications throughout Racine County and Wisconsin. At the conclusion of the presentation, Sheriff Schmeling and the lead investigator will be available to answer questions and provide documentation. The Racine Sheriff's Office made the announcement Wednesday on their Facebook page. And here we see they're to announce these statewide election law violations. Members of the media press are invited to attend a news conference, etc., etc. Gateway Pundit friend and news source Jefferson Davis will be at the briefing tomorrow. So a little short snippet as to what is going on there. Obviously, if you're paying attention to what's going on in Arizona and Georgia and Pennsylvania, well, perhaps we got some things going on in Wisconsin that are going to be a little noteworthy here in just a couple hours, and we'll see whether or not it spawns an audit and what comes of that, huh? So aside from that, interesting piece out of 100% Fed Up here says, how can I as a father trust you? Loudoun County dad of 4 girls delivers blistering statement calling for school board to resign. And of course, Loudoun County has been in the limelight here as of late based on the BS that took place there. And on top of that, we talked a little bit about McAuliffe yesterday. He's in a challenging environment to see if he's going to get elected. So calls for Loudoun County school board members to resign are growing louder and louder. Angry parents say they cannot trust the school board and the superintendent who participated in the cover-up of a rape to push the transgender bathroom agenda. One dad called for the resignation of the board members in a blistering statement. A Loudoun County dad of 4 young girls, the tweet incorrectly states, 3 girls. How can I as a father trust you and you as a school board to keep my daughter safe at school? I can't. I ask you to resign.
This is my first time speaking at a school board meeting, but I can no longer remain silent. I have 4 young daughters, the oldest of which just entered Loudoun County Public Schools. I'm extremely concerned about the sexual assaults which occurred. A school should be a safe place for children to come, not a place for the highest levels of leadership of the school district to cover up what happens in the district. Let me get this straight. A high school student sexually assaults another student and the penalty is to move him to another school with an ankle brace. That's lunacy. What is also lunacy is lying to the victim's father in a public meeting about it, and then he's the one that gets in trouble. That is calling good evil and evil good. Your policies are contributing to creating an unsafe environment in the schools. I do not want boys in my daughter's bathrooms. I do not want boys on my daughter's sports teams. How can I, as a father, trust you as a superintendent and you as a school board to keep my daughter safe at school? Why would I want to entrust you with all of our daughters once they become school age? The answer is I can't. Dr. Ziegler, I ask you to resign, and all the board members, I ask you to resign as well.
Pretty succinct and to the point, huh? Says the parents of Loudoun County and all parents across the country need to be able to trust teachers and school boards. They do have a right to a voice in the education of their children, even if Dems don't believe it. vote in people who value parents like Glenn Youngkin in the Virginia governor's race. Says, all right, yeah. So, bottom line, yes, people's voices are being heard. And of course, like we covered here yesterday, Minnesota thought otherwise and decided, oh, you know what? We're going to put these rules in place to where you actually have to give your address and where you live and phone number and all that stuff, basically, so people can hunt you down afterwards as, any sort of rebuttal from their folks. And so, to that, I would question, all right, in the event that happens, who's going to get sued out of that? School board? Maybe. We'll have to see. So, yeah, continues. Outside of that, DC Clothesline says, why does Pfizer's own website state that one of its COVID shots is approved, while the one they dispense is only authorized? This on the heels of what we now know the FDA is pushing for 5 to 11-year-olds not to get the jab. Never mind the fact that the FDA has got some Pfizer folks on their board as well. Says, we told you there was something fishy about the unconstitutional claims of the Food and Drug Administration's full approval of Pfizer's COVID shots. And now even the Pfizer site states that their BNT162b2 shot is, quote, not approved or licensed by the U.S. Food and Drug Administration, end quote. Right on their website. See that? Facebook, YouTube, Google, Pfizer, right there. Not medical misinformation, it's on their website. Here's the language from Pfizer's own site. This product information is intended only for residents of the United States. This product is exclusively distributed within the U.S. under an emergency use authorization from the FDA. The Pfizer BioNTech COVID-19 vaccine has not been approved or licensed by the U.S. Food and Drug Administration, but has been authorized for emergency use by FDA under an emergency use authorization to prevent coronavirus disease 2019, aka COVID-19, for use in individuals 16 years of age and older. The emergency use of this product is only authorized for the duration of the declaration that circumstances exist justifying the authorization of emergency use of the medical product under Section 564b1 of the FD&C Act, unless the declaration is terminated or authorization revoked sooner. Please see EUA fact sheet at cvdvaccine.com. So here's how that page on the Pfizer BioNTech COVID-19 vaccine, also known as BNT162b2, appears as of October 26, 2021. There we see it, right there, black and white. Says when one clicks on the link here, one can select I am not a healthcare professional and will be taken to this page, to Comirnaty, the one that has been approved. Notice what we read there, FDA approved. For 16 years old and up. Notice the bait and switch taking place. First, Pfizer declares the FDA authorized the emergency use of their COVID-19 quote-unquote vaccine. Second, Pfizer states that on August 23, 2021, their Comirnaty shot received FDA approval. These are two different shots. How do I know this? Read the fine print after the asterisk above, where it says the licensed Comirnaty vaccine has the same formulation as the authorized vaccine Pfizer BioNTech COVID-19 vaccine, and the products can be used interchangeably to provide the vaccination series without presenting any safety or effectiveness concerns. The products are legally distinct, with certain differences that do not impact safety or effectiveness. Right there, right? So there you have it. So they claim it is that they can be interchangeable, but only one is authorized while the other remains in EUA status. Get it? Yeah. It appears the FDA and Pfizer are deceiving the people about what is really going on with this shot. Just to be clear, the labeling by Pfizer, which was uploaded on October 2021, declares the following. You are being offered either Comirnaty COVID-19 vaccine mRNA or the Pfizer BioNTech COVID-19 vaccine to prevent coronavirus disease 2019, COVID-19 caused by SARS-CoV-2. This vaccine information fact sheet for recipients and caregivers comprises the fact sheets for the authorized Pfizer-BioNTech COVID-19 vaccine and also includes information about the FDA licensed vaccine, Comirnaty. The FDA-approved Comirnaty vaccine and the FDA-authorized Pfizer-BioNTech COVID-19 vaccine under emergency use authorization have the same formulation and can be used interchangeably to provide doses for COVID-19 primary vaccination or a booster dose. And here's their fact sheet. Revised 20th October 2021. See, they're telling you there are two shots and claim they can be used interchangeably, but they also tell you they are both legally distinct with certain differences. Which one are people getting in the US? The FDA approved one or the FDA EUA one? According to attorney Robert Barnes, Comirnaty was not available to the US market, but the EUA Pfizer BioNTech BNT162b2 shot is. Dr. David Martin seems to agree. So, the bottom line, I think we've covered that before. It seems to be somewhat of a bait and switch, obviously, to probably confuse the masses into what they think they're getting. And of course, the Mockingbird media tropes and that will run with that and say, oh, see, it's approved. But yet it's not, and it's also not available, right? So, that's all we got here for the morning show today. Appreciate you guys tuning in as always, and we'll be back here, probably a little bit later on. I think I may jump over to the old 5x5 channel this afternoon. Jump on with Homesteader here. Looks like old Drunk Pinata may be out of pocket here this afternoon, so we'll give that a go as a pre-show to 412 show here this afternoon over on WTPI, and we'll see you then. Take care. God bless, everybody.